Hello Forex traders, hope you all are well. With your prayers we will share a new video and discuss a topic. That topic is stop out level. Maximum traders don't know about this, so those who don't know, definitely watch this video till the end, because if you don't know about it, you won't know when your balance will end. So please watch the video patiently for 5 minutes. In today's video, we have just a single topic, and that is the stop out level. What does stop out level or stop out actually mean? Stop out level gives the same instructions as margin call, but it is more dangerous than margin call. In the language of Forex trading, stop out level is called stop out when the margin level of the trading account crosses a certain limit. It is always displayed as a percentage. If somehow your trading account comes close to the stop out level, then all the entry positions you have will be automatically closed, and those entries could be in profit or loss. Surely you understand that this is not a good thing. That's why I request you to watch the video patiently, so that we can explain it to you. This is mainly due to lack of funds. That means when your trading account cannot sustain the existing entries. As a result, they close automatically after a period of time. In other words, the stop out level is when your equity comes below the amount of used margin. In such a situation, the broker will automatically close all your existing entry positions, but the entries with the highest amount of loss will be closed first and will continue to do so until your margin level rises to stop out level. The broker basically does this work so that your trading account losses do not increase and so that you get a chance to recover some losses. Basically, the level at which the broker automatically closes the trading position is called stop out. This is likely to happen when our balance decreases or floating losses increase. Your running loss is floating loss. After opening a trade, either it goes towards profit or towards loss, but that loss or profit is not added to the account. When you close that entry, the amount will be added as profit or subtract as loss. So after opening the trade, when your entry goes towards loss, it is called floating loss, and when your entry goes towards profit, then it is called floating profit. They will remain running as long as your entry is running, and when you close the entry, they will be closed and added to or subtracted from your main balance. Again, you must know about used margin. A part of your balance is locked by the broker to take entry. It is called used margin. So stop out happens when your floating loss goes below your used margin. So understand what is meant by this. Suppose you are trading on a broker where the stop out level is 20%. That is, if somehow the margin level of your trading account approaches 20%, then the existing entries will be automatically closed. One thing to remember: if you are in such a situation, the broker closes the most losing entry so that the margin level can be increased, because when your entry is closed, the blocked funds will be free, and it will increase the balance. The more entries you close, the more used margins will be released and become free margins. Hope you have understood the stop out level in today's video. And if you still do not subscribe to our channel, please subscribe and click the bell icon for never miss any update.
We will make a request to you wherever you create an account, broker house or payment gateway. You must use the FOREX BD link. This will keep your account safe at all times. You will be able to participate in any type of contest. You will have the opportunity to trade in 0 pips spread. So be sure to account under the link given below. And if you like this video, don't forget to click the like button, because your likes and comments give us confidence to do something better. And if you have any suggestions, you can leave a comment so that Forex BD can meet your needs all the time.